Hey guys, Ken Perry with the Knowledge Coop. I brought in Jeff Foody, and Jeff's a reverse mortgage expert, and I know absolutely nothing about reverse mortgages. I know that they are for people over the age of 62.
Yes, sir.
And that's pretty much where it ends. So what I thought I'd do is, for those who don't know anything about reverse mortgages, I thought we'd have you, Jeff, explain a little bit about just the basics of reverse mortgage. So take me from you have to be 62 and go from there.
All right. So you have to be at least 62. You have to own the home. It doesn't necessarily have to be outright, but at least has to be your home. It can't be renting or anything like that. It's essentially a government-sponsored benefits program. Okay, you don't think of it like a normal mortgage or a traditional loan. It allows someone that's over 62 to access the equity in their home without having to make payments or repay.
And so the thing actually pays the homeowner back?
Correct. So or if they have an existing mortgage, it can get rid of their existing mortgage. If they own the house free and clear, they'll have a chunk of change that they'll be able to access that they can either take monthly installments from or take a big lump sum from, but allows them to get money out of their house without having to repay.
So I owe $200,000, I've got a $400,000 home, and you would be able to access how much of that extra $200,000 in equity?
The amount of money you qualify for depends on their age. The younger they are, the less they qualify for. The older they are, the more they qualify for. So
it's like life insurance.
Exactly. It's based off of mortality tables.
Oh, okay.
Okay. So let's say a person has a $400,000 house. If they owe $200,000, they'll be able to get out enough to pay off the existing mortgage and maybe pull out a little bit extra cash.
So,
maybe not.
But they have no payment, right?
Well, they'll have no payment. So they qualify for, say, 220 grand.
Okay.
They could pay off their $200,000 mortgage, never have another mortgage payment, and they got 20 grand to go stick in the bank to do whatever they want.
Never, like, ever?
Never, ever. As long as they keep up their taxes and insurance, they never have to repay it as long as they're living in the house.
So if they live till 99?
Doesn't matter.
Wow.
Even if the house goes upside down in value,
They've still got it. All right. And I remember when they first came out, I was a little nervous when I started hearing about them because I thought, well, if they die next week, the bank just scored all that equity, but it's not like that anymore.
No, the program's been around since '89, where it's been the government program. It started out kind of as an annuity concept, where companies would come in and basically buy the house from the seniors, allow them to live in it, and then they would be able to take the house back afterwards. In '89, when it became a government program, now it's just a loan like any other. There's a lien against the property. They still own the home. It's still in their name. There's terms that as long as they meet the terms of the loan, they can never be left in the dark.
So how would you default on one?
If you stop paying your property taxes or stop paying your homeowner's insurance.
Otherwise, you're good to go.
Otherwise, you're good to go. Or if you leave the house, if you vacate the property, if you if you move into a care facility or something like that, where you're permanently going to be there, or if you buy a second home and use that as an investment property. But as long as it's your primary residence and you keep up your taxes and insurance, you can never default.
So what if you have a second home in Florida and one here? Can you do a second home?
You can only do it on your primary residence.
Okay. And so you use the equity. You've got that. It's never going away. What happens if you do die a couple of years later, what happens with the house at that point?
So the amount of money that they've used, plus whatever interest has accrued on it, will be repaid by the heirs. So the house will go to the heirs. The heirs will have a time period, usually about 12 months, to figure out whether they want to refinance it to keep the house, whether they want to sell it and just keep whatever equity's there, or if the house is upside down in value, they can just walk away from it, so they don't want to deal with it.
Really?
These are a government-insured loan. They're a non-recourse loan.
So government-insured like FHA? Or
FHA.
like,
They're all FHA.
Okay.
So in the case of a borrower where it's upside down, the heirs would have the option, if they want to keep the house, they could keep the house at 95% of the appraised value, even if it's upside down.
Gotcha. So actually you can get out of it. What do you base the payment on as far as the payment that goes back to the senior? Let me make sure I understand your question correctly. So the payment that they're able to draw off of? Yeah.
Okay, so the amount of money that they're able to qualify for, there's basically two different types of reverse mortgages. There's an adjustable rate and there's a fixed rate. A fixed rate requires a lump sum distribution. Okay, you however much money you're
getting it all out right there?
Getting it all out.
Okay,
right?
Gotcha.
With the adjustable rate, you've got other options. You can take a monthly installment. You can leave some in a line of credit. You have options on how to take the funds. And they can determine however much money they want to take every month. They could say, well, I just like $500 every month for life. I can say, give me $500 every month, but come Christmas time, I want $2,000 for a couple of months,
Wow.
and then go back to maybe nothing for a few months. It's completely flexible.
And so they could can they change it so that they set it up and 3 months later they go, I want more money? Can
Yep.
they go back and, do they do it like online or?
They would contact their servicers. Usually there's a form they have to fill out, and they can do it once a month, and they can change it as often as they need to. No charge to them, no cost to them. The real advantage currently is now they've got this big line of credit option, where the line of credit actually has a growth rate. So whatever money they don't use is sitting in a line of credit that's actually growing for them.
So they're making money off their.
Correct.
Wow.
So however much money they're getting, so let's say a 62-year-old qualifies for $200,000, and they decide not to use any of it, but just leave all of it in line of credit. Right now, the line of credits are getting between about 4 and 4.5% interest. And it
Wow.
just continues to grow, and it has nothing to do with the value of the house. If the value of the house goes down, that line of credit is going to continue to grow for them.
So I think on my savings account right now, I pay
Yeah.
them interest to be able
Yeah.
to keep my money. So
Yeah, it doesn't quite work the
That's a
same.
little better for a senior.
Yeah.
What are the risks?
The risks are, worst case scenario, if you took out all of the money and the interest accumulated, there's not going to be any equity left to your heirs.
Okay.
That's the worst thing that can happen.
Really?
Mhm.
But as long as you're paying your tax and insurance, you're good to go.
Yeah. You can't owe any more than that. So the worst thing that can possibly happen is they pass away and there's no equity in the house to leave to the kids. That's the worst thing that can happen.
Let's say a borrower gets a reverse mortgage, paying just fine.
Mhm.
Would they ever want to refi out of the reverse?
Very rarely does that happen. I've had people that have refinanced it because houses have gone up in value and they wanted to pull out more money
Into another reverse?
into another reverse. They just
Oh,
took a
okay.
streamlined refinance where now the house of values have gone up 50, 100 grand. They want to pull out another 20 or 30 grand. I've had that happen a few times. Or if the one spouse is 62 and the other one's 58 and isn't able to qualify, they do it just on the one spouse, and then when the other spouse turns 62, they refinance to add them to the loan. We've had that happen, but not too often is it where they're refinancing out to do a traditional mortgage. Usually it's not the case.
So when you've got two borrowers, who do you base your underwrite on?
It's always on the age of the youngest borrower.
Okay.
And they have to be at least 62. If you've got a spouse that's under 62, it's what they call a non-borrowing spouse, they would not be on the loan, they would not be on the title to the house.
Wow. So they've got to be completely off that thing.
Completely off. They're very rarely do we do them. I mean, they're doable and they're common, but we kind of advise against it because if something happens in the course of that time, they may have to, it's not a happy situation. So we strongly suggest not doing a non-borrowing spouse unless there's a foreclosure situation or they're just really strapped financially, they can't make the mortgage payment anymore. We do them all the time. I've done a couple last month, but we try not to. The ideal situation is to have both borrowers on the title to the house and they don't have any risk.
Wow. So if you've got a borrower, still trying to wrap my mind
Sure.
around it. You got a borrower, you're getting an underwritten using something like an FHA guideline or just going through
completely
FHA, but not?
Yeah, it's completely FHA. It's
So
all
what are the
FHA
guidelines? Are they risk wouldn't be a factor as far as credit.
No income, no credit.
It's like the only true
It's
Nina.
all on the asset.
Okay.
It's all about the asset. The house has to meet FHA standards. That's
Because you don't
we're
care if
taking
the
all the
borrower
risk.
is going to pay you back because they're not
Doesn't
making a
Correct.
payment. Wow. So you're just approved based on your age and your asset.
That's exactly right.
Who does the appraisal?
FHA approved appraiser.
So same as a normal FHA?
Same as FHA.
Wow. Do you ever have arguments about the appraised value where they think it's worth?
All the time.
So same thing as we deal with on a
Absolutely.
regular FHA
Yeah,
loan?
absolutely, all the time. They have an idea in their mind of what they think that it's going to be worth X amount. Then when they come in, it's not nearly what they think, and absolutely that happens all the time.
So there may be a situation where you've got a reverse mortgage been referred to you, because I know you get a lot of reverse mortgage referrals.
Yep.
So a reverse mortgage is referred to you, you go out for it, it's just not coming up reverse. Is there a situation where you might send that back and go, look, this guy might be a great refi?
All the time. Yeah, all the
because
time.
I can't do it at this point.
all
Okay.
the time. There are usually the only times that happens is usually if the appraisal comes in lower than we think it is, and they're not qualifying for enough to get rid of any existing liens on the property.
Okay.
So in your case, when we said 400,000, they owe 200,000. Well, maybe the appraisal comes in at 350, and they're not able to get out enough. Well, then I'll usually refer that off to a forward mortgage guy, and I use that phrase "forward mortgage guy" because in my world, they're the weird ones. Right?
Nice.
The forward mortgage guys, and I have referred to them for them to try and refinance to do something else with it.
Gotcha. How much of the process for you is, I imagine there's a lot more consulting and conversations that go on.
A great deal.
There's probably a lot more people involved in the conversation.
Absolutely.
So there's a lot more of that involved?
Absolutely. Well, the first step that's different with a reverse mortgage is typically when I get a forward mortgage referral, usually they'll have pulled credit and they'll take a what do you guys call it, a 1003?
Yeah,
right.
Yeah. That's what we weird people call it.
You weird people call it.
Yep.
And they'll take all of that and then they'll send me the information. With reverse mortgages, it doesn't work like that. The first step is we find out about their situation, what they're trying to do. We send them to a third-party counseling first, and they'll talk to a HUD-approved or ARP-approved counselor. They'll go through that process before we take an application, before we do anything else, so that they're educated and they understand how the program works. Once that's done and we get the certificate that says I've completed counseling, then we take a 1009, which is basically around the same thing, except we don't ask for assets and that sort of stuff.
Right.
And we'll take a 1009, and then we'll pull credit, and then we'll order an appraisal.
So you still pull credit even though you don't care?
Only because we want to make sure there's no outstanding federal liens.
Gotcha.
Other than that, credit, we don't really care.
Okay.
Except with these new rules, they came out a couple years ago, if there's a foreclosure or a short sale in the last 3 years.
Okay.
So other than that, we don't care. If they're in bankruptcy, doesn't matter. I mean, we can help those. If they're in foreclosure, we can go ahead and save them because, again, the credit scores don't matter. So at this point, the only reason we pull the credit is for those reasons.
With forward mortgages, there's all kinds of different areas.
I like that you're using that term.
I am. I'm moving away. So I'm about to call them reverse and you forward. So in a forward mortgage situation, there's all kinds of just stops in the process where it just gets super meaty and you just kind of, it's a pain. In a reverse mortgage, where is the area where if you're doing a reverse mortgage, you're going to see like a super big break in the system and it's like we can't get over this hump kind of a thing?
Usually it's all about the property.
Okay.
It's all about the property. If it's a manufactured home in a mobile home park that they don't own the property. Yeah, we do manufactured homes all the time. Yeah, absolutely.
A reverse on a manufactured home?
Yep, as long as it's not in a park. As long as they own the property, absolutely. Single wide, double wide.
Single wide manufactured home.
Absolutely.
Not in a park.
Correct. As long as they
you
own
can
the
give them
property,
like $10.
Maybe
back,
8, depends.
8 or 9.
Yeah, we actually just had a client down in Klamath Falls last week. The appraisal is $27,000 appraised value.
Nice.
Yeah. So I mean, we absolutely manufactured homes.
Wow.
We can do. So, but if the manufactured home's been moved, or if it was built before 1978, can't touch it. And some lender, and that's generically speaking, there are some lenders out there who won't touch reverse mortgages at manufactured homes.
Because the lender has to actually, so you've got overlays just like the forward mortgage side.
Yeah, sure.
Okay.
So there's some investors that say we won't do manufactured homes. There's some that say, well, we cut it off in 1991. The FHA rule is 1978, and we can do manufactured homes as long as it's on a permanent foundation. If it's not, you can have it done. You can have like tie downs and stuff put in before the loan closes. But yeah, we do manufactured homes. The other big things that asset wise is we just ran across one a couple weeks ago. It's a manufactured home in a flood zone, and it was below the floodplain by like a foot. And so that one dead, can't do anything with it.
Yeah. So appraisal is obviously a big issue. Is there?
Yeah, that's the big issue because everything's on the asset.
In dealing with the family, are there some tips? Do you want to get everybody together and deal with it ahead of time?
Absolutely, because I mean there are. This is the last loan they're ever going to have. I mean, they usually don't refinance out of it. This is the last one they're going to have.
So your referral business kind of sucks.
They're not coming
churning,
back after.
You're not able to churn.
There's not a lot of refinance.
Referral can be good because they could be.
Because they're usually happy with it. Hey, I don't have a mortgage payment anymore, and they're willing to refer friends, and that's great. But they're not usually coming back and being my client again in 3 years or 5 years. That's very rare. But yeah, they're financial advisors, they're attorneys, they're CPAs.
Oh, so you're not even just talking family. You're getting
we talk with all of their
involved.
decision makers. Yeah, and we usually do that before the counseling session. We say, okay, well, who's involved in your decision making process? I mean, honestly, I'd say that 80% of my job is, in the forward mortgage world, they have to figure out product. They've got to figure based on this rate and based on this income, you've got to fit it into this mold to do this product. We don't do that. I mean, this is it. It works or it doesn't work. Most of our job is educating. I mean, it's explaining to them how the program works, explaining to their kids how the program works. 80% of my job is counseling. That's really the vast majority of what we do. And a lot of it is explaining misunderstandings. Oh, I'm going to lose my house. I'm signing over the title to my home. All of these misconceptions that people have. I mean, this program came out in 1989. And so it's been 25 years, and we're still trying to tell people, 35 years, we're still trying to tell people, you keep the house. It's still in your name. You still have the title. It's still all in your control. And that's the number one issue we still face with people. They think they're going to lose the house.
So if they've got advisors, they can get in there and actually find out that it's not.
Absolutely. Yeah.
Do you deal with a lot of skepticism then? Are they like, wait a second, buddy, you know, what do you got going on? And
Yeah, I'd say that, really the big knock on reverse mortgages used to be their expense. And this was probably 6 months ago. There was a big change that happened in October. But there's a big upfront mortgage insurance premium of 2% of the appraised value. And so when you tie that in.
They have mortgage insurance on something that can very, very rarely default.
Absolutely, because it's
Go
FHA.
FHA.
Yeah, it's FHA.
Wow.
They're going to make sure that their
My
butts are covered.
gosh.
Oh, well, you know, there's not much chance of defaulting, but 2 years ago, after people took out reverse mortgages 5, 6, 7 years ago, all of a sudden the housing market tanked.
Right.
They had them for a while. There was a ton that were upside down. They passed away, and there was a ton left in, and so FHA had to have the insurance for that.
So that insures them against that.
Correct.
Okay, I get
Correct.
it.
Yeah.
I get
So
it.
there was the reason for that. So, but the cost was the big thing. Was there were huge mortgage insurance premium plus an origination fee and the third-party closing costs. It wasn't unheard of for somebody to spend $15,000 in closing costs because they've got an $8,000 mortgage insurance premium.
Right.
That wasn't
Plus you make
unheard of.
$799 on every deal.
Well, usually I say 14, 15. But,
Nice.
but even
Way
with,
to go old school.
You know, even the origination fees on these are all federally regulated. So we're only limited to what we can make. But still, there's that sticker shock. They're like, well, so a CPA or a financial advisor is going to look at this and say, okay, so your $400,000 house, you're getting a $200,000 loan, but it's costing you $15,000. That's the skepticism. Is that cost for the mortgage insurance premium? Now, as of October, that's changed. If a client takes less than 60% of the amount that's qualified that they're able to get, if they take less than 60%, the mortgage insurance premium is only half of a point.
Oh, okay.
So now the closing costs are a whole lot cheaper.
So the biggest closing costs are the government taking there too.
Yeah.
Wow.
Yeah.
So much easier now, I guess, to get through some of that skepticism. If
A great
if
deal
there's-
more.
okay.
Yeah, now you start to see financial advisors are writing articles about this on their trade publications. They're saying now the new reverse mortgage. Everything's all about the new reverse mortgage.
Right.
It's a whole different program than it was 6 months ago.
When it used to be FHA, or wasn't there private
There was
party?
proprietary.
Okay.
There was a lot of proprietary products, and now we're starting to see more proprietary products starting to come back out again. We're starting to see jumbo products for houses because these are all FHA products. So
Right.
they use FHA county lending limits,
Yeah.
which is capped at 625.5. So if someone's got a $1 million home, that $625,000 lending limit where they're only getting 400 grand doesn't really help.
Right.
So now proprietary products are coming back. They're starting to do where you can use them on second homes, that's brand new. I mean, that's just been no one had heard of doing those before. But yeah, for larger loan limits, they're a lot more popular now.
Are those being, I guess, driven by the increase in values? But is there a lot of money to be made on those? I mean,
Yeah, I mean, the difference is when FHA came out in October and changed the program where they were shrinking the mortgage insurance premiums, they also shrank the amount of money the borrowers qualified. So they cut the loans amount by about 10 to 15%. So they were getting less money, so they were taking less risk, which is why they shortened it. Well, there's a lot of people that were finding that they weren't able to qualify anymore because now that 10 to 15% that got cut out isn't enough to pay off their existing liens. So now the proprietary products started coming out and saying, well, we'll use the same guidelines as they were before, so now this client doesn't qualify under FHA guidelines, but under the proprietary product, they get another 10 to 15% more. Now they
Gotcha.
can do it.
gotcha. So they're picking up what was basically
Yeah,
dropped.
exactly.
Okay.
Exactly.
Wow. So that's. Are you concerned at all about some? I mean, we have a history in the forward side of proprietary programs coming out and lenders coming up with crazy programs that can really damage consumers. Are you concerned at all about that, or is it a different player in that market than we've seen in the past?
I say yes and no. I'd say that if you asked people what they've heard of or those horror stories about reverse mortgages where their grandma lost the home,
Right.
those were proprietary products from 20 years ago. So they damaged the image then. Now, there hasn't been a proprietary product in the business for probably 3 to 5 years. Everything was FHA because that's all they could do. Now these new proprietary products are coming out. I'm a little skeptical because I prefer the government insurance. I prefer knowing that there's no risk of them being able to lose the home.
Right.
So the proprietary products sound great as it's ancillary to the main product.
Okay, so if I'm a loan officer, I know nothing about reverse. I'm getting this initial information on reverse mortgages. if I wanted to go out and figure out how to do great reverse mortgages and like be an expert, how long, study wise, going to trainings, you know, whatever I can do, how long would it take me to be a level where I can do a loan and really not mess it up, but not just not mess it up, do a really good job at a loan?
You know, it's tough because there's really not a whole, at this point, there's been a lot of contraction in the reverse mortgage world. So having new people coming in, there's really not a whole lot of good training available for them. And when we're hiring new people, it's usually we're throwing them in and trying to teach them how the product works. I mean, you're not even really getting into sales skills and stuff yet to really make it a good loan officer. And the other side is trying to get forward mortgage loan officers to think like a reverse mortgage. I mean, it's a whole different world. I mean, the people that you're selling to, the demographic of people that you're selling to they're seniors. They're all, most of my clients, 95% of my conversations in a day are people that are 70 to 75 years old. And selling to that demographic is different. Yeah, I'm not emailing them over documents and having them sign them and e-sign them and email them back to me. It doesn't work with this demographic, you know? And so
hit them up on Facebook. You just tweet out.
Yeah, exactly. Yeah, I'll just tweet to them. They're
on Snapchat all the time. I get some crazy Snapchats from the senior center locally.
I do have clients that text me, you know, where are we on things, and that's getting better. But usually it's not. So for a new loan officer coming to the field, there's a lot of training that needs to take place. And where they'd go to find that, the National Reverse Mortgage Lenders Association.
Oh, nice.
Has had, you know, they've got their own kind of governing body.
NRMLA.
Nice. Yeah. And they do a lot of really good work with educating new loan officers, but
a long time to become.
A long time to be, you know, I'd say it's probably going to take you a year and a half of constant loans to really be really proficient at it.
So I want to do something here, just because it drives me insane when somebody, you know, if you're a loan officer and you're like, I've never done FHA before, I think you can pick up an FHA and there's enough people around you to walk you through. I mean, it's still a forward mortgage. My concern is that people will go, I've never done reverse before, here's a reverse, let me learn on the job. And that's not a really good way to do it.
Not at all. I mean, when you look at forward mortgages, you've got all these arrows in your quiver. You've got, I can do this sort of loan, I can do this sort of loan, I can do this sort of loan. Reverse mortgage isn't just another arrow that you stick in the quiver and say, oh, my company can do reverse mortgages, so I do them. They don't work like that at all. And especially considering you're using a program that is designed for a protected class. You've got to know what you're doing. You've got to know what you're doing. And so that's why in most markets in the area, you find a person that's been doing it for a set period of time. They usually own the market in that area because people refer him because they know he's the guy who knows what he's doing.
So you don't do forwards at all?
I don't do forwards at all. I couldn't refinance your house if my life depended on it. I don't know anything about it.
Awesome.
I don't know anything about them.
So be really careful is what you're saying.
Be really careful. Be really, really careful.
Okay. So not a learn on the job kind of a thing?
Not at all.
Right on.
No.
Well, that's a great list of things, man. Thank you for giving us the proper basics of reverse mortgages.
Yeah, no problem at all.
All right.